I'm Rachel Horgan. Join me each episode as I sit down with a guest co-host covering the latest business stories in the Seattle area. We'll read the news so you don't have to. This is The Weekly. Welcome back, everybody. It's a nice rainy day today in Seattle on a Friday. I'm loving it. I'm not sure if I'm going to love it in a few months, but right now I am. And this weekend, I'm going to go see the movie My Old Ass with Aubrey Plaza and Maisie Stella. It's written and directed by Megan Park, so I'm excited to go see that. And I love them. I love me a movie theater, especially a 21 and over theater. So that'll be fun. But today, I've got my tech bro vest on, and I had my tech badge on. But that's because we're talking all things VC funds. I'm here with Vivek Ladsariya, Managing Director at Pioneer Square Labs. Hello.
Hello. Thank you for having me here.
I know. This worked out perfectly. So I'm contracting over at Avalera, which is just down the street. So I was able to kind of walk over here and record at Pioneer Square Labs. If you're not familiar, it's right over by Good Bar. It's right above Good Bar.
Yeah.
And next to Flat Stick Pub over here. Do you guys go down there a lot?
Yeah, that's where I park.
Oh, there you go.
Yeah.
Yeah.
And I'm excited about going to the Larry David show tonight. He's in town doing a conversation with Larry David, so that should be fun too.
Oh, look at us. Look at us. I love that. A little bit more about you. Pioneer Square Labs is a venture capital fund founded in 2015. And prior to this, he was the general partner at SineWave Ventures in San Francisco. And he's founded a few of his own companies. So you started at Pioneer Square Labs, we were just talking like 6 months ago, right?
That's right. I've been here. I moved up here late in the spring, enjoyed the summer here, and now I'm getting used to the rainy Seattle days as well.
Yeah, definitely. And I got connected. You came recommended from Julie Sandler over here, and she said that this is going to be your first Seattle podcast. So this is a weekly exclusive, right?
That's right. Yeah, I'm excited to make my Seattle podcast debut with you.
I love it. I love it. Well, before we get into the stories, I always want to ask, why you're passionate about what you do. So for you, you have a long history of working in VC funds. Why is that attractive to you?
Yeah, I think this goes a little bit before that, even when I started my own companies. For me, that's always been the passion of creating something from nothing, helping create companies that can one day become meaningful companies in the world, making significant impact in the world. And there's an opportunity to create that from scratch. I did that as a founder, and to me, being a VC was just an extension of that. The ability to help the future generation of founders start companies, share some of my experience and learnings and lessons with them, be able to fund them, and in the process, create some era-defining companies.
Yeah, that's awesome. Well, we've got 4 stories for you today, and we're going full tech, AI, everything world. And luckily there's plenty of stories to talk about. So number 1, Smartsheet is selling to private equity. Number 2, we have an electric boat engine company going into receivership, and we'll talk about what that is. Number 3, a deep fake startup is getting funding. And our last one is NVIDIA, which is a chip company, is acquiring a Seattle startup. So are you ready?
Yeah, exciting slew of topics.
Okay, so this one there's a lot of background on this one. So Smartsheet, we've talked about it before. If you remember the episode with Maria Colacorcio, she was a co-founder way back in the day. It was founded in 2005. So the news article that's coming out is that they have agreed to be acquired by 2 private equity firms, Blackstone and Vista Equity Partners, in a deal valued at $8.4 billion. Quite a bit. And if you're not familiar with Smartsheet, it's basically Excel on crack. Like, it is just a huge project management software company. It's a really big company here. They have over 3,000 employees. It serves 85% of the Fortune 500 companies, so it works a lot with some of those bigger companies. This is an all-cash deal, and it's 6 years after Smartsheet went public. So again, they were founded in 2005. They went public 6 years ago, and now they're going back to being private with this purchase from private equity. This is expected to close in January, so it's not totally done, but it kind of seems like it'll happen. And Vivek, I'm going to ask your opinion here in a few minutes here, but it's pending shareholder approval, and then it has a 45, what's called go shop period, basically meaning, is there anybody else that wants to buy this for probably more than $8.4 billion? What else to say? Something interesting is that the COO resigned right before this, and that there was no more information in the article, but I have questions about what's going on there. Anyway, that's what's happening. Vivek, why do you think they decided to go do this after being around for 20 years? I mean, we had Nordstrom that's also trying to go private. Why do you think that's happening?
And it seems to be happening across the board, right? The company you contract for, Avalara, went private recently. Yeah. They were public as well. One of my partners was one of the original founders of Rover.com, which is the biggest dog sitting company. They were public. They went private recently as well, acquired by Blackstone for a little over $2 billion. So there seems to be a bit of a trend. And if you look back to Twitter being acquired by Elon Musk, that was a similar kind of transaction. Even if there wasn't a private equity firm involved at the face of it, it was at the back of it, backed by several private equity firms. And Twitter was a public company that went private for well over $40 billion. I forget what the exact price was. So this seems to be a bit of a trend in the last few years. And I think it's driven by a few factors. One, staying public is a huge burden on companies. So companies choose to go public because they want access to money that private investors and private markets just can't fulfill anymore. Mm-hmm. But being public also comes with its own set of baggage. You have to report out your financials every 3 months. You have to be accountable to public market expectations on your financials every 3 months. And that can be somewhat handcuffing to long-term growth for businesses. Obviously, that's not true for certain businesses like NVIDIA or Meta, who have done great as public market companies. But for several companies, that can be quite a challenge. And I think with Smartsheet specifically, that was because they are in quite a competitive industry. You spoke about how they are a lot like Excel, but just supercharged. But there are now lots of companies that do that.
Yeah.
They see competition from Airtable,
I think
Asana maybe. Yeah, there are just so many that are head-on competitors with them. So it's a tough market to continue to grow in. And that can be a really nice opportunity for a private equity firm to come take a company private, so it does not have to worry about all of servicing the public markets, reposition itself for long-term growth, invest so that it can grow over a 5-year period rather than being focused on the quarterly goals. And sometimes those can be at odds. If you're trying to focus on having the best performance over the next quarter, that's not usually conducive for 5-year growth. And that going private can really allow you to do that.
Yeah, so it's less immediate pressure because the shareholders are like every quarter, every month must be better. Then you've got private equity comes in and is like, here's some allowance, like take your time, just, eventually do better. But there is still the pressure from private equity. It's not, they are still going to expect some returns on that.
Absolutely. They are. And, when we talk about growth for a business, it's always from two aspects. One is growing your revenue, or what people might call the top line. And then there's growth from reducing costs so that your bottom line or your net income can be highest. Mm-hmm. And from private equity, there's going to be pressure on both sides, where they want to grow the top line pretty significantly, but they also want to reduce costs. And you alluded to the COO leaving. I should be extremely clear. I don't know why that is either. So there is no information in here, but if I had to make guesses, it has to do with something along the lines of costs, the cost structure at Smartsheet not being in excellent shape, and the private equity firm seeing it as an opportunity to reduce the cost structure of the business as well.
Yeah, because it said something about revenue was increasing and rising, but it was still showing an operating loss of $8.5 million, which is less than before. So I live in the expenses world because I do events, and so I feel like a lot of times sales and companies will be like, we got X amount of $1 million in revenue. I'm like, yeah, but our event costs quite a bit too. So yeah, that's interesting that they're still operating at a loss.
And if you look back to the Twitter go private transaction, soon after Twitter went private, Elon Musk fired close to half the workforce. And there wasn't really a significant disruption to the Twitter service if you're a user of it. I'm not, but I think there wasn't very much of a disruption to the Twitter service. I would expect something similar coming out of the Smartsheet go private, where there'd be significant focus on making cuts, leaning up the organization so that it's no more a loss-making company, but more of a profit company.
One more question before we move on, and I have a pretty openly biased view of private equity. I feel like they come in, they buy a company, and then it just almost immediately goes downhill. And obviously that's not the case with Avalara. They're doing fine. But, we saw that with Azulali. We have seen it with some other companies. Do you have an opinion on private equity?
I can certainly see how that's the popular opinion around private equity, and pop culture in general hasn't ever positioned them as the good guys.
Yeah.
It's always the bad guys. But I don't think that's necessarily the case. They wouldn't be around if companies that they bought didn't do well or went downhill consistently. That model as a business model wouldn't exist. The reason it exists is, on the average, on a portfolio level, they are doing really well. They are still able to generate portfolios that continue to grow and prove out the model. And that's why they stay in business. So occasionally there are going to be cases that don't perform, but that's the benefit of creating a portfolio where the whole model doesn't rely on the success or failure of just the one investment. It's about the 15 or 20 investments that the private equity firm is making as a portfolio. How well is it doing? Yeah.
Well, any good podcast has disagreement, so I'll let it be. Okay, so we're going to move on to our next one, which is this Seattle electric boat engine company called Pure Watercraft. It entered into what's called receivership this July. Basically means they can't pay their debts. And in my Googling, I think we've talked about this in one episode, but it's basically someone is appointed to take possession of the company and sell or liquidate the assets. Then the other part of this interesting is that GM, General Motors, took 25% stake in the company in 2021 and has invested $35 million. So they're probably sad. But Vivek, can you talk a little bit about receivership versus bankruptcy, and have you dealt with any companies that have gone through that?
Yeah, any VC that has been a VC for long enough has dealt with companies that are going under, so to speak. So I do, and maybe we'll touch on that a little bit. The difference between receivership and bankruptcy, at least from my standpoint, is quite simple. Bankruptcy is optional, where you file for bankruptcy because you decide that that's the best way to deal with the debt that you have that you can't handle. And both of these are usually when you have too much debt and you can't handle it anymore and you want a way out. Bankruptcy is the optional way out. Receivership is when you're forced into it. So you're forced into it by your creditors, where they recognize that you can't service that debt anymore and say, well, you know what, let's go into receivership so we can salvage whatever asset value there is in the company to recoup our debt.
Would there be a possibility of them coming back? Like, let's say they liquidate all their assets, they pay their debts. Could they still start up this company again with the money that they've made from selling and stuff, or are they just done?
They could, because one thing that's probably been created in this company is the intellectual property. The IP still exists, so that has some value, and maybe that's sold in a liquidation. Maybe, as an example, another electric boat company might buy that IP and now they run it. So there is no more opportunity for Pure Watercraft to be around. But someone is going to buy that IP and someone is going to start it up again. Yeah. Because there is value. If you believe that there is value in electric, what is it? Speedboats, motorboats?
Electric boat engine, but then I think they were also selling boats as a whole as well. Right.
And so if you believe in a future where there are electric boats of that type, you believe that IP will be monetized and started up by someone else. Yeah. Where either they buy it through receivership. It's possible that the same founders go and buy the IP back from the company and start it up as a separate company. You referenced GM. Yeah. Was it GM? GM. Yeah. It's possible that GM buys that IP and starts up an electric boat division within GM. So all of those are possible. So I don't think in all of these, the company doesn't go away. That there are, if there are employees in the company, doesn't mean that all of them are out of a job right away. Mm-hmm. They could all have a job. They could all have a job in a different company, a different version of this company down the road. But the premise is the existing company, the way the company is structured today can't continue to service the debts. And that's not that uncommon in such capital intensive businesses, right? So when you're trying to build boat engines, that's so complex. You have to have manufacturing and be able to sell it for more. Think back to so many stories that we've heard, to reference our friend Elon Musk, or not our friend Elon Musk again. Tesla went through several iterations of this, where they were on the brink of bankruptcy multiple times in its journey. But because he's such a powerful fundraiser, he was always able to go raise more money to save the business. It's not that uncommon for businesses that are so complex for them to go under when they're not able to go raise more capital to service the debt.
I feel like if I were a founder, receivership would be like the most embarrassing way to go, because it's like somebody else telling you like you got to be done here. Yeah.
It's not a highlight. It's not something you're very proud of.
Do you feel like, I know just from reading the article, obviously you don't know their whole business plan, but do you have speculations as to why you think it didn't work, why the business model didn't work?
I don't think it's that. I don't think there's a secret to why this business model didn't work. It's difficult. Any hardware business in general is really, really hard. Margins are tight.
Yep.
It costs a lot of money to build a boat or an engine. And then when you sell it, you don't often get a really, really high price when you're selling it. So margins are really tight, and you have to make a lot of different things work within that small, tight margin. So it's not like a software business. We invest in software companies where gross margins, the cost of building a product and cost of selling the price that you get from selling the product, the gross margins are usually north of 75%, sometimes 80%, sometimes 85%. Yeah. So you're getting a lot of margin to work with.
Right, and not as much overhead as buying both.
Exactly, and building hardware is always really complex.
Yeah. So do you have, I want to go more to your specific experience. You've dealt with a lot of founders pitching you companies. Do you have a story of something that like you thought was going to do well, that was such a great idea and then ended up going bankrupt, or, any kind of stories like that?
Yeah. My first investment, and when we walk out, I'll show it to you because an artifact from that investment is sitting on my desk and I can look at it right there, is a company called Jibo. Jibo was a social robot. Think of the Alexas and Google Homes that people have, but this one had a lot more character. It was cute, it was fun, it would move around and talk to you. The idea was very much have a social friend in your house that can do all the things Alexa can do for you. But this was all before Alexa too. So this wasn't after Alexa, this was all before Alexa. And it was quite the rage. They were wildly popular. They launched on Kickstarter, and right off the bat, they sold $5 million worth of units. They were sold out within half a day. They were on the cover of Time magazine as the invention of the year. There was a lot of complex robotics in it. That all came out of MIT, and a professor at MIT who was a researcher. And they were on the cover of Time magazine as the invention of the year. The following April, they went under.
Wow.
And that's because as a hardware company, you just burn through cash so quickly before you reach profitability. And you need to be able to raise a lot of money to allow yourself the time to reach profitability. And that company wasn't able to do that. So it hit some tough times. We didn't go into bankruptcy or receivership. So not quite as much of a stigma associated with. We were able to sell the company and its IP and recoup some of the investment from it, but was certainly a case of not successful investment. And again, the hardware comparison is pretty relevant. I imagine it's the same story with a lot of different hardware companies.
Yeah, it's tough to do. Anything else before we move on?
No.
Okay. All right. Another startup, Loti or Loti, I don't know. Seattle startup raised close to $7 million from Silicon Valley, your old stomping grounds. It was founded 2 years ago, so a relatively new company. And what it does is it helps public figures scour the internet for fake social media accounts, fake endorsements, or what's called deep fakes that misuse their likeness. It's founded by three people, Luke, Rebecca, and Hirak. And Luke previously ran an AI consulting firm. So AI is a whole separate podcast, but I guess, what's your general thoughts on AI? I'm guessing you're into it because you're investing in AI companies.
That's right. I am overall usually very pro new tech innovations. Okay. And not that AI is a new tech innovation. I think the term was coined in the 1960s, and there has been tons of innovations over the years, and we've seen many iterations of that over the years. We've seen AI play a role in our lives over the last 2 decades without maybe realizing it as much as we are now. So certainly the current iteration of it, which is the generative AI, where AI can generate something, is catching people's attention the most, but I'm certainly very pro it. I think it's going to allow us to do some pretty incredible things that are, as humanity, as humans, it's going to help us a lot.
Yeah. I didn't prep you for this question, but I was thinking about it. I saw this TikTok about how when innovations happened before, we all wanted and needed it. So for example, like the iPod coming out, we didn't, that's way better than a Walkman. A laptop, of course, now we can move around. And so all these things that we're like, oh, I want that right away. And now we're moving into this area where people are having to convince us that we want this or need this. And an example I saw was a commercial for Instagram's new AI search feature. And they were showing me like what I could do with it. I'm like, listen, all I need to do is search my ex and see what she's doing. Like, I don't need AI on my Instagram. Like, I know what I'm looking for there, right?
Yeah.
So do you feel like with your companies, are they solving for problems anymore? Or are they coming up with things that they're having to convince people that they need?
I think AI is solving real problems and will solve real problems. Now, are there places where it's being slapped on without having a real use case or value proposition? Also, yes.
Yeah.
So I think there's both, but by and large, AI is and will be used to solve some real problems.
Yeah.
If you think about medicine, AI will change how we detect cancer. AI will change how we develop drugs. Engineering, AI is already writing over half the code that is written, half the new code that is being written across the US, certainly across our portfolio. And those are tangible benefits of AI that we are seeing today already. And over the next 5 years, I think that'll be dramatically more so.
Yeah, I mean, I'm all for that, especially helping with healthcare and things like that. So this startup gets this funding, and you're in the room when founders are pitching you. So what do you think what do you think they get right, and what do you think they do wrong when founders are coming in to pitch for VC funding?
So the biggest mistake a founder can make going into VC funding is being too obsessed about their product or their solution and not enough about the problem.
Yeah.
So a lot like what you were talking about, Yeah. Don't tell me what I can do.
It can do
with
this, and it can do that, and it can do this. And you're like, okay, but why?
Why? The why. What are you trying to solve?
Yeah.
And I think that is the core question, because that's what stays true. How you solve it will always keep it evolving. You solve it today by using the internet. Tomorrow you might want to solve it using text messages, or the Instagram AI example that you were referencing. You might solve it with new improving innovations, but the core problem, is that a real valuable problem? Is that a problem that enough people truly feel, or is that just nice to have? No one pays for nice to haves.
Right.
There very rarely do we pay for nice to haves, but we all pay for a set of contact lenses. We if you need it, you need it. If you need a laptop, you need a laptop. You're going to pay for it. So what is the why of starting a company? And I think founders need to focus on that at the core when they're meeting with VCs.
Yeah, that's really good advice. I like that. I was going to, this is talking a little bit about deep fakes and things like that. So do you think we're going to see a lot more companies coming up with security? I think so. Security and protections to balance kind of all of these innovations.
I think it's such an important topic. So generative AI is presenting us this opportunity to create new content using AI. And I think that in itself is a huge plus. It's a good thing that we can do that. We can generate, like I said, new code. We can generate detections of cancer cells. And all of that is net positive. But the downside is you can create these deep fakes without people's authorization, often in quite malicious ways. And that's not okay. And that needs to be prevented. And with any new technology, there's always this negative use case that is going to emerge. I think that's true of the internet. You can make the same argument of all of the negative things that came with the internet, but by and large, it just changed the way humans operated and lived. Right.
Yeah.
And so certainly there will be innovations to try and protect us and continue to protect us, and bad actors will continue to try and find a way to fight those ways and continue to find new innovative ways to use the technology in a negative way. But I think there will be enough entrepreneurs who will continue to solve.
Are you seeing that with your conversations? People are pitching you security stuff?
Absolutely.
Yeah.
So security stuff, from preventing or protecting yourself from AI, that there's a lot of that. We have a company in our portfolio called the Official AI. And what Official does is allows people to use the power of generative AI for good. Imagine you're Shaquille O'Neal. You don't want to fly to Cleveland to shoot a commercial. How about we use generative AI to create new content of Shaquille O'Neal holding a bottle of Coke and do it in an official, authorized way?
A purposeful deep fake.
A purposeful deep fake. Well, one that's official, one that's
Yeah.
authorized, and that can save a lot of money for Shaquille O'Neal's time is extremely valuable. He doesn't want to fly to Cleveland, and Coke doesn't want to pay for all of that.
Right.
And they get him for one day. That's too much pressure to get the shoot right in that one day, where here they could do all of it using AI.
Yeah.
So just in purposeful deep fakes, that there's a lot of value to be created, and official is doing that. So it's, you reference Loti, which is trying to find and remove and eliminate deepfakes. I think that's a really important problem. And on the flip side, how do you use generative AI to actually purposefully create content in a way that's going to change how marketing is done down the road? And there are companies pitching us on all ends of the spectrum there.
Yeah, I bet. All right, our last story today is NVIDIA acquires a Seattle startup. This Seattle startup sells tools to help build and run generative AI models more efficiently. Don't totally know what that means, but obviously they're in the AI space. And NVIDIA is that chip company, and it acquired it for, we don't know the exact number. The article I saw was between 150 million and 250 million. It spun out of UW, which I think is cool. And it has raised more than 132 million since 2019. The co-founder and CEO is now going to be the VP of AI systems software. So oftentimes when a company buys the other company, that doesn't, like, CEOs don't always stay on. There's no position for them. The CFO, it doesn't stay on because, NVIDIA already has a CFO, that kind of thing. But in this case, the CEO is going to be the VP of AI systems. Whenever I read these kinds of things, I know this is your world, but the fact that they've raised so much money, I'm like, what happened to starting a company and then making it profitable pretty quickly? I feel like there's so much more of a runway with a lot of companies these days where it's like, sure, here's 132 million, take your time. But in this case, it worked and NVIDIA purchased them. So you started your own companies. Was your goal to get acquired when you started your companies?
No, I don't think anyone I shouldn't say anyone, but for most entrepreneurs, the goal is not to get acquired.
Okay.
The goal is to solve a problem and build a sustaining, profitable business. And the absolute goal is to take it public. Go be Meta or NVIDIA and be the largest company in the world. So very much the goal was to solve the problem. Now, along the way, there are challenges in building a business. It's really, really, really hard to build a business from the ground up. And it's also, as you start to become increasingly valuable, as you start to really solve a problem, there are other people who are in that space who are also trying to solve that problem and say, okay, well, you know what? Octo AI has figured out something here. Maybe we should just buy them. And they come and make you an offer and you can't refuse it. And so you end up selling. So along the way, people end up selling it because they get offers that they can't refuse. But no, certainly not my goal wasn't to sell a company.
Yeah. And then I have a reporter friend that wanted me to ask that this deal didn't show up in the SEC filings. Why is that? And do some have to report and some don't? Do you have an answer to this one?
Yeah. So it's about the size of the deal. So compared to public companies would have to report an acquisition if it's material to their finances. Now, NVIDIA is an extremely large company. That they are one of the largest companies in the world. An acquisition of this size was perhaps immaterial to NVIDIA, that they don't have to report all of the details behind it.
Oh, a little 250 million. Not big enough.
It's quite a rounding error in NVIDIA's financials.
Yeah, I bet.
And so they just don't have to report the details of the acquisition of that size. So what you can gather from that is that it was probably a smaller acquisition, not something all of the investors or the founder hoped for or set out hoping for. It wasn't the multi-billion-dollar exit that would make the news from that standpoint, but it was perhaps the right time to find a home. The company maybe didn't have a path to profitability. This is conjecture. I'm imagining
right.
reasons why one would sell. And so it seemed like this would be a great place to go sell into NVIDIA and continue building within NVIDIA.
And then one more question. I've heard that sometimes when a company's bought, like I assume, the founders are going to get rich, they're going to buy a mansion. But I've heard that isn't always the case, that the founders really end up with that much money. Can you speak to kind of what happens when a company gets bought and where that money goes?
Yeah. So you're spot on. It's not always the case that the founders make money. And in fact, more often than not, founders don't make any money from exits.
Wow.
And that's because of how much money gets invested into these companies. So when investors invest in these companies, they buy what's called a preferred share, as opposed to what founders have, that is common shares. Now, preferred shares have a preference when a liquidity event or an acquisition is a liquidity event. When that happens, the money first goes to pay back the investors. So in Octo's case, if they raised $130 million, a vast majority of the acquisition price went back to paying back the investors.
Yeah, your debts, yeah.
Right? And those are not debts. Those are investors
Loans,
in your company.
Okay, yeah.
These are not loans either.
Oh.
These are pure investments. So none of them have a debt relationship with the company. It's an equity relationship, but still, because it's preferred equity, the money goes back to pay the investors first. And what's left off the top is then something that may go to the founders. So usually it's pretty low unless it's a massive outcome. Unless a company gets acquired for many times the amount that was invested in it, it's usually not a case where the founders make a lot of money.
Yeah, I think that's a common misconception then, yeah. Interesting. Yeah. Okay, well, we're at time, so I want to ask you, what is the best piece of advice that you've ever received, and or what advice do you have for our listeners?
This is hard to boil down into one best piece of advice, but the one that comes to my mind right away is be absolutely true to yourself and don't bullshit yourself. I think early on in my career, and perhaps true for many people, it's so easy to get in this trap of bullshitting yourself, thinking of yourself as too good for something and too above certain things, or overestimating your own capabilities. That's not helpful. And so the best piece of advice I got was, how can I be true to myself, really, really be self-aware, understand my limitations and my capabilities, and build on my capabilities. And it sounds very generic, but once you internalize it, that I think it can be really, really powerful and helpful. Once you really build that relationship with yourself where you can be completely candid, completely honest about your limitations, that to me has been the biggest unlock in my career.
Yeah, I love that. That's great advice. Well, Vivek, thank you so much for taking the time to sit down with me and for hosting me over here at Pioneer Square Labs. I appreciate it.
Thank you. Thank you for coming. And right on cue, the sun's coming out.
This has been The Weekly, with production assistance from Nick Patry. If you liked what you heard, rate us and write a review on Apple Podcast or Spotify. We love listener feedback, so if you have any story suggestions, comments, or complaints, email us at info@theweeklyseattle.com. Make sure to check back next Sunday for the latest local business news. We'll see you next time.